Hi pension subscribers and welcome back to the channel. My name's Dominic James Murray, CEO and founder here at Cameron James. Okay, so today we're going to be discussing the fact that 95% of clients are still invested in their default funds at their DC schemes or defined contribution schemes. Okay, so to start off with, why is this a problem? Well, the default funds inside your DC scheme are by definition default. It means they're not conservative, they're not adventurous, they're somewhere in between. And everyone is put inside the same default fund if you do not select any other type of funds inside your defined contribution scheme. So why does this happen? Well, the first point is that when you start a new job, lots of things are happening. On page 27 of your terms and conditions, it'll talk about your pension scheme, and there'll probably be a box for you to select if you wish to select your own funds. However, most people don't even understand their options and just go into the default fund. Now, the problem with this is it just doesn't really make sense. Out of everything you do in your life, your broadband, okay, maybe your broadband costs you 20, 30, 40, 50 pounds per month, depending on whatever package you have. I'm sure you shop around continuously to get the best deal, and you probably feel really happy with yourself. I've managed to save 10 or 20 pounds per month on my broadband deal. Why are people not doing the same with their funds? Why are people allowing their defined contribution to be invested in complete and utter default funds? So, what are some of the main disadvantages of default funds? Well, default funds, as I've mentioned, they are by definition default, which means it's not tailored to your background. You might be very, very young and wanting to take a more aggressive approach of your investments. If you're in your 20s, 30s or 40s, you should really be taking on more level of investment risk in your earlier years as you have time to recover from any periods or any financial crises. For example, on the other side, if you're in your 50s or even in your 60s, you might want to scale back from default funds and you might want to be more conservative to ensure that if there is a market correction, it's obviously not going to affect your retirement. Now, the reason default funds are there is just that it's simple. It's simple for the employer, it's simple for the scheme, everyone's invested in the same thing, very, very easy. That doesn't necessarily mean you're going to have the best outcome though. If you compare the default funds against the market, generally speaking, they nearly always underperform. Why do they underperform? One of the main reasons is that UK default funds have a huge bias to UK stocks. Now, unless you've been living in the cave, you will understand that the UK is not the only investment market in the world. The United States has always outperformed the UK in terms of investment growth over the long term. The number of companies, IPOs, any company which is doing particularly well right now, any of the big consumers and electronic companies that you talk about, it's normally always based out, or technology I should say, it's normally always based out of the United States. So UK default funds always have an overweighting to UK stocks, which isn't necessarily what you would get if you went to an independent financial advisor. They would give you a diversified range of assets, which allow you to have a better investment growth opportunities, but also protect you from downside risk by obviously being diversified. So what I would say to my clients is, number one, you should always be finding out what funds are available inside your defined contribution schemes. Generally speaking, you will find out and you'll be pretty disappointed. There might be a range of 10, 15, 20, 25 or 30 underlying default funds which you can select. Now, one of the big problems with this is that very often they will be branded the same as your defined contribution scheme. So whether it be Zurich, Standard Life, anyone like that, it will normally say something like the Zurich Balanced Portfolio or the Zurich Default Model Portfolio. What that means is that they're effectively taking that asset from someone else, typically white labeling it, and then charging you a higher premium than what you would pay for that fund if you just bought it yourself independently inside a SIP or another type of solution. So what I would say to my clients is wake up. This is one of your biggest assets possibly. I mean, if you have a defined benefit scheme, that might well be bigger than your defined contribution assets. But as the world continues, defined benefit schemes are becoming less and less common. Defined contribution schemes are extremely important. So you need to get in touch, find out how you can change your funds around. But once you start doing this research, ask yourself, why am I even in my DC scheme? If it's your current employer, WPS as we call it, your workplace pension scheme, it makes sense to definitely stay inside your DC scheme so you can have your contributions from yourself and your employer, which is extremely tax efficient and beneficial to you. Any previous DC schemes though, you should, in my opinion, my professional opinion, be looking to consolidate those down to a SIP solution where you can have full control and management over that asset. That will ensure that you will, by default, you will never end up in default funds. You will have a proper portfolio put together for you based on your risk rating. So for example, if you're a balanced adventurous investor, you may well have an equity weighting of 65, 70 or even 75% inside your portfolio compared to your default funds in your DC scheme, which might have a 40, 50, 55% equity weighting. Over the course of 5, 10, 15, 20 years, that can make a considerable difference to the amount of money you will have in retirement. So guys, I hope this has been a useful video for you today. And again, my message is wake up with DCs. Take control. If your scheme doesn't have a good fund selection, get out. Whether it's with us or whether it's another financial advisor, take control. Get yourself into a SIP, or at the very, very minimum, understand what the difference between your DC scheme is and what the difference is with a SIP, and decide which you think is more suitable for you. Guys, if you'd like to book yourself in for a free initial consultation, you can go down below into the description. You can click on the calendar link, find a day and time that's suitable for you. Likewise, you can also go to the WhatsApp button in the description, and you'll go straight through to have a conversation with myself to get you booked in, or just to have a quick chat. Guys, I hope this has been useful. Let me know what you're doing with your DC schemes. Let me know if you're in default funds, if you've chosen default funds after having a look, or chosen different types of funds. Really interested to find out, and look forward to speaking with you on the next video. Thank you, subscribers, and goodbye.